In the second half of 2024, a personal financial behavior research report released by a state-owned bank showed that nearly 70% of respondents had made regretful decisions when dealing with idle funds. Some invested 200,000 yuan in a short-term wealth management product advertised as high yield. But after deducting handling fees, the actual return was less than 1%, far lower than the current time deposit rate. Some fell for low-interest consumer loan ads, borrowing 100,000 yuan for home renovations, only to find that the actual annualized interest rate exceeded 12% after final calculation. Others repaid their mortgages blindly in advance and had to apply for operating loans at higher interest rates when they needed funds urgently later. Why do seemingly well-thought-out financial choices end up in a passive position? This common decision-making dilemma points to a core financial principle that is overlooked by most people: the time value of money. With the continuous advancement of interest rate liberalization and the increasing complexity of financial products, not understanding this underlying logic is like feeling the elephant blindfolded in the financial market. It's easy to be misled by superficial figures and pay hidden wealth costs. Today, we will systematically break down the core logic of the time value of money, explain the practical application of its derivative tools in detail by combining the latest financial data, regulatory policy cases, and real market scenarios, and help readers establish a rational financial decision-making framework to achieve sound management of wealth in various fund operation scenarios such as mortgages, investments, and credit. First off, it's important to clarify that the time value of money is not simply equivalent to the loss of purchasing power caused by inflation. Its core essence lies in the interest-earning capacity of money itself in different time periods. The same amount of currency has different actual values due to different appreciation potentials. This characteristic is not a theoretical assumption, but an objective law verified by countless market data and real cases. According to the fourth quarter 2024 Monetary Policy Implementation report released by the People's Bank of China (PBOC), the weighted average interest rate of one-year time deposits of domestic financial institutions that year was 1.48%. The average yield of three-year Treasury bonds was 2.92%. The central level of the 7-day annualized yield of money market funds remained in the range of 1.75% to 1.85%. And the benchmark interest rate for demand deposits had been stable at 0.25% for a long time. Based on these real interest rate data, we can clearly see the specific impact of the time value of money. Assuming holding 100,000 yuan of idle funds, without considering the difference in compound interest reinvestment, the scale of funds after 5 years will show a significant gap depending on the choice of low-risk deposit methods. If kept in a demand deposit account for a long time, calculated at an annualized interest rate of 0.25%, the total principal and interest after 5 years will be about 101,260 yuan, after deducting the average annual inflation rate of about 2% during the same period. Data from the National Bureau of Statistics in 2024, the actual purchasing power will instead shrink. If choosing one-year time deposits with automatic renewal with the effect of compound interest, the total principal and interest after 5 years will be about 107,730 yuan, which can partially cover inflation but has limited appreciation effect. If allocating 3-year Treasury bonds and renewing the principal and interest into 2-year time deposits after maturity, the average interest rate of 2-year time deposits in 2024 was 2.45%. The total principal and interest after 5 years can reach 115,600 yuan, achieving significant positive appreciation. While investing the funds in money market funds, calculated at an annualized yield of 1.8% with compound interest, the total principal and interest after 5 years will be about 109,330 yuan, balancing liquidity and certain appreciation. This wealth gap caused by different time periods and appreciation channels will show an exponential amplification trend in the long term. Taking a 30-year cycle, the same 100,000 yuan, calculated at an annualized return rate of 3% with compound interest, the final principal and interest can reach 242,700 yuan. Calculated at an annualized return rate of 5%, the principal and interest will exceed 432,200 yuan, with a gap of more than 180,000 yuan. This law also profoundly explains the underlying logic of many financial behaviors in reality. Why do large enterprises often strive for longer payment terms in business cooperation, and even willing to pay a certain percentage of liquidated damages to delay payment? Essentially, it is to use the interest-earning capacity of funds during the credit period to create additional value. For example, a leading manufacturing enterprise extended the credit period of its annual accounts payable of 20 billion yuan from 30 days to 60 days by optimizing the payment cycle, and could achieve additional annual income of more than 50 million yuan only by purchasing short-term wealth management products. Why do landlords in the rental market prefer to require one-time payment of 3 months or even half a year's rent? The core is that the funds recovered in advance can appreciate through financial management. Calculated at the 2.92% yield of 3-year treasury bonds, collecting 60,000 yuan of half-year rent in one lump sum can bring an additional financial income of about 876 yuan in half a year compared with collecting 10,000 yuan per month. Why do more and more workplace people choose to transfer funds on the day of salary payment, moving their salaries into money market funds or short-term wealth management products? Precisely to avoid the idleness of funds in demand deposit accounts. Calculated at an annualized yield of 1.8%. A workplace person with a monthly income of 10,000 yuan can get an additional hidden income of about 135 yuan per year if the monthly funds enter the financial management account 15 days in advance, which is a considerable amount of wealth accumulated over the long term. These seemingly daily financial choices are actually precise applications of the time value of money. After understanding the core of the time value of money, two derivative concepts, present value PV and future value FV, become the basic tools for mastering financial decisions. Future value refers to the total amount of current currency after appreciation at a certain point in the future. Its calculation formula is FV equals PV times 1RN, where R is the periodic interest rate and N is the time period. This formula accurately quantifies the appreciation potential of funds over time. In 2024, the interest rates of 5-year large denomination certificates of deposit CDs, launched by many state-owned banks, generally ranged from 3.05% to 3.15%. Taking a 5-year large denomination CD with an interest rate of 3.1% from a certain bank as an example. If 200,000 yuan is invested now, the future value after 5 years will be 21 plus 3.1%, 5,233,000 yuan. According to compound interest calculation, the 33,000 yuan appreciation part is the direct embodiment of the time value of money over the 5-year cycle. It is worth noting that different compounding frequencies will have a slight impact on the future value. If compounded monthly, the future value of the above 200,000 yuan after 5 years will reach 233,500 yuan, which is about 500 yuan more than compounded annually. This also explains why some wealth management products emphasize monthly compound interest calculation, essentially to enhance product attractiveness by increasing the compounding frequency. Corresponding to future value, present value is a core indicator that converts the monetary amount at a certain point in the future into the current value. The calculation formula is PVFV divided by 1RN. Because current currency has interest-earning capacity, the actual current value of a fixed amount at a future point in time must be lower than its nominal amount. This characteristic is the key to judging the real value of various financial products. In the financial market, the principle of present value is widely used in core areas such as bond pricing and wealth management product valuation. Taking the third issue of electronic savings treasury bonds issued by the Ministry of Finance in 2024 as an example, the face value of this treasury bond is 100 yuan, the term is 3 years, the coupon rate is 2.92%, and the principal and interest are repaid in a lump sum at maturity. That is to say, after holding it for 3 years, you can receive 100 yuan of principal and 8.76 yuan of interest, totaling 108.76 yuan. If the weighted average interest rate of 3-year time deposits of financial institutions during the same period to 0.75% is used as the risk-free rate of return discount rate, the reasonable current value of this treasury bond should be 108.76 divided by 1 plus 2.75%, approximately equals 100.75 yuan. through the present value formula calculation. This calculation result provides investors with a clear decision-making basis. If buying this treasury bond in the secondary market at a price lower than 100.75 yuan, the return after holding it to maturity will be higher than that of the current time deposit. If the purchase price is higher than 100.75 yuan, it is better to choose time deposits directly. In fact, the trading price of this issue of treasury bonds in the interbank bond market in 2024 always fluctuated around the range of 100.7 to 100.9 yuan, which fully confirms the guiding role of the present value principle in market pricing. For ordinary investors, the greatest practical value of the present value principle lies in realizing the fair comparison of funds at different time nodes and avoiding being misled by nominal amounts. In real life, we often face the dilemma of choosing between immediate income and future income, such as whether to accept schemes provided by enterprises, such as advance payment of year-end bonuses with discount and installment, repayment of housing purchase discounts. At this time, rational decisions can be made through present value calculation. Taking a common fund payment choice as an example. Option 1 is to get 950,000 yuan now, and option 2 is to get 1.05 million yuan in 3 years. If only comparing the nominal amounts, the total amount of option 2 is higher. But considering the time value, it is necessary to judge its real value through present value calculation. Referring to the 2.92% yield of 3-year treasury bonds in 2024 as the discount rate, the present value of 1.05 million yuan in 3 years is 105 won plus 2.92%, 3,968,500 yuan, which is higher than the 950,000 yuan available now, so option 2 is more cost-effective. However, if the market risk-free rate of return rises, such as the 3-year time deposit rate rising to 3.5%, the present value of 1.05 million yuan in 3 years will drop to 105 won plus 3.5%, 947,200 yuan, which is lower than 950,000 yuan, and at this time option 1 is better. This calculation logic is also applicable to scenarios such as pension planning and insurance compensation amount selection, helping people make fair fund decisions across time dimensions. When future cash flows are distributed in multiple periods, the core logic of present value calculation remains unchanged. It is only necessary to convert each period of cash flow into the current value separately, and then sum them up to get the overall real value. Investment, but after being split into different time nodes, there may be actual losses after present value conversion. Taking a closed-end wealth management product launched by a joint stock bank in 2024 as an example, the product rules are: initial investment of 100,000 yuan, 20,000 yuan returned in the first year, 30,000 yuan in the second year, and 60,000 yuan in the third year. The promotional page highlights total repayment of 110,000 yuan, total return of 10%. If only looking at the total return data, the product seems to have investment value. But combined with the 3% market risk-free rate discount rate in 2024, its real value should be the sum of the present values of the repayment amounts in each period. 1 plus 3% plus 3 divided by 1 plus 3% A plus 6 divided by 1 plus 3% A approximately equals 1.94 plus 2.83 plus 5.49 equals 102,600 yuan, which is indeed higher than the initial investment of 100,000 yuan, so it has certain investment value. However, if the repayment amount of the product in the third year drops to 55,000 yuan, the total repayment amount becomes 105,000 yuan nominal return rate of 5%, and the total value after present value conversion is 1.94 plus 2.83 plus 5.03 equals 98,000 yuan, which is lower than the initial investment of 100,000 yuan. At this time, investing in this product will actually cause hidden losses. It is worth noting that such products with nominal profit but actual loss are not uncommon in the market. Especially some short-term wealth management products create the illusion of high returns by splitting cash flows. If ordinary investors do not master the present value calculation method, they are likely to fall into investment misunderstandings. In present value calculation, the choice of discount rate directly determines the accuracy of the calculation result. And the core reference standard for the discount rate is another key concept in financial decision-making: opportunity cost. Opportunity cost refers to the highest return among all other alternatives that are given up after choosing a certain plan. In an ideal, perfectly competitive market, the discount rate and opportunity cost are theoretically completely equal. While in the real financial market, the essence of the discount rate is the investor's minimum acceptable rate of return, and its core basis is the highest risk-free return that can be obtained by giving up other investment channels. This logic is not only applicable to personal financial decisions, but also runs through the investment evaluation process of enterprises. The domestic risk-free return market in 2024 showed a diversified pattern, with low-risk products of different terms and types forming a clear return gradient. The weighted average yield of one-year Treasury bond reverse repurchase in the interbank market was 2.08%. The central level of the 7-day annualized yield of money market funds was 1.8%. The average interest rate of 3-year time deposits of state-owned banks was 2.75%. The interest rate of 5-year large denomination CDs was 3.1%, and the yield of policy financial bonds was 2.85%. For investors holding idle funds, if they can allocate 5-year large denomination CDs through formal channels, their highest risk-free return is 3.1%. This return level constitutes the opportunity cost benchmark for all their investment decisions. Correspondingly, when calculating the present value of other investment projects, 3.1% should be used as the core discount rate. Taking a private lending scenario as an example, if someone puts forward a borrowing request and promises to repay 100,000 yuan in a year, the reasonable borrowing amount now should be determined through present value calculation. 10 won plus 3.1% 97,000 yuan. This means that if the borrowing amount exceeds 97,000 yuan, such as lending 100,000 yuan and only getting back 102,000 yuan in a year, the actual return rate of this loan is 10.2 10 divided by 10 equals 2%, which is lower than the 3.1% opportunity cost, so it is not a cost-effective transaction from a financial perspective. If the borrowing amount is 97,000 yuan and 100,000 yuan is recovered in a year, the actual return rate is exactly equal to the opportunity cost, which is a fair transaction. If the borrowing amount is lower than 97,000 yuan, excess returns can be obtained. Opportunity cost is not fixed, but changes dynamically with market environment, policy adjustments, and personal asset status. This change will directly affect the discount rate, and then change the present value evaluation results of various assets. The adjustment of regulatory policies in the domestic financial management market from 2023 to 2024 clearly shows the impact of opportunity cost on asset value. In 2023, the annualized return rate of bank wealth management products sold through some internet platforms could reach 4.2%. And they had the attribute of rigid redemption. The regulatory policy had not been fully tightened at that time. At this time, the investor's opportunity cost benchmark was 4.2%. If evaluating a corporate bond with an annualized return of 3.5% at that time, calculating with 4.2% as the discount rate, the present value of the bond would inevitably be lower than the face value, so it lacked investment attractiveness. In 2024, with the full implementation of the new asset management regulations, the wealth management products sold through internet platforms completely broke the rigid redemption, and the return rate generally dropped to 2.8%. The investor's opportunity cost benchmark then dropped to 3.1%, the interest rate of 5-year large denomination CDs. At this time, evaluating the same corporate bond with an annualized return of 3.5% with 3.1% as the discount rate, its present value will be higher than the face value, making it have investment value. This change also explains why the bond market has been bullish since 2024. The targeted RRR cuts and interest rate cuts implemented by the central bank have reduced the overall market interest rate level. The opportunity cost of the whole society has generally decreased, leading to the rise of the present value of fixed income assets such as bonds, and the prices have naturally risen accordingly. According to data from the China Bond Information Network, the yield of domestic 10-year Treasury bonds dropped from 2.95% at the beginning of 2024 to 2.68% at the end of the year, and the corresponding Treasury bond price rose by about 2.5%. One of the core driving factors for this increase is the decline in opportunity cost. The connotation of opportunity cost varies significantly among different groups. For enterprises, opportunity cost is more reflected in financing costs. According to the 2024 statistical data from the China Banking and Insurance Regulatory Commission (CBIRC), the average financing cost of domestic medium-sized enterprises through bank loans is 6.45%. That of small and micro enterprises is about 7.2%, and that of listed companies through issuing corporate bonds is. When evaluating investment projects, enterprises must take their own financing costs as the core discount rate benchmark if the expected return rate of the project is lower than the financing cost. It means that the project return cannot cover the capital cost, and it will inevitably lose money after investment, so it is better to return the funds to the creditors. If the expected return rate of the project is higher than the financing cost, the project is feasible for investment. Taking a manufacturing enterprise as an example, its financing cost through bank loans is 6.5%. If it plans to invest in a new production line, and the expected annualized return rate of the production line is calculated to be 7.8%, which is higher than the financing cost, so the project is feasible. If the calculated return rate is only 6.2%, the project should be abandoned. For ordinary individuals, the manifestations of opportunity cost are more diverse, among which the mortgage interest rate is the core opportunity cost benchmark for most families. According to the 2024 data from the central bank, the average interest rate of existing housing loans in China is 4.75%. If a family holds idle funds and can only find a low-risk financial return of 3%, then repaying the mortgage in advance becomes a rational choice. Because repaying the mortgage in advance is equivalent to locking in a risk-free annual return of 4.75%, which is much higher than the 3% opportunity cost. On the contrary, if a stable investment channel with an annualized return of more than 5% can be found, and the investment risk is controllable, then the funds can be used for investment to achieve wealth appreciation through the return difference. If present value, future value, and opportunity cost are the basic tools for understanding the time value of money, then the internal rate of return IRR is the core weapon to see through the superficial figures of financial products and understand the real returns. The essence of IRR is a special discount rate that makes the sum of the present values of all future cash flows of an investment project equal to the initial investment amount. Simply put, IRR is the real annualized return rate of the investment project. Its greatest advantage is that it can take into account the time distribution of cash flows, avoiding being misled by superficial figures such as total return and average return. The low-interest trap in credit card installment business is a typical scenario where IRR plays an identifying role. According to the consumer complaint data released by the Consumer Rights Protection Bureau of the China Banking and Insurance Regulatory Commission in 2024, complaints about credit card installment business accounted for 18.6%, among which the actual interest rate is inconsistent with the advertised interest rate was the main reason for complaints. The credit card installment activity launched by a joint stock bank in 2024 is a typical case. The promotional page marked 12 installment annualized interest rate of 5.8%, and the specific rule is that 100,000 yuan is repaid in 12 installments with a monthly repayment amount of括号10万加10万乘 5.8%一括回除以12约等于 8816.67 yuan. From the superficial figures, the annualized interest rate of 5.8% seems to be at a reasonable level, but the nature of the trap can be immediately exposed through IRR calculation. Inputting the initial cash flow 100,000 yuan, i.e., capital outflow, and the monthly cash inflows of 12 months 8,816.67 yuan, i.e., capital inflow into a financial calculation tool. The monthly IRR can be obtained as about 0.87%. And the annualized IRR equals 0.87% times 12 approximately equals 10.44%, which is almost twice the advertised interest rate. The core reason for this difference is that the installment business adopts the flat interest method for interest calculation. The interest is always calculated based on the initial principal of 100,000 yuan. In fact, the borrower repays part of the principal every month, and the remaining principal decreases month by month. But the interest does not decrease accordingly, resulting in a significant increase in the average cost of the actual occupied funds. In contrast, the equal principal and interest calculation method interest decreases with principal reduction adopted by formal banks. Taking the same 100,000 yuan loan for 12 installments with an annualized interest rate of 5.8% as an example, the interest in the first month equals 100,000 times 5.8% divided by 12 approximately equals 483.33 yuan. The principal repaid in the current month equals 8,816.67 to 483.33 approximately equals 8,333.34 yuan. The remaining principal in the second month equals 100,000 to 8,333.34 equals 91,666.66 yuan. The interest in the current month equals 91,666.66 times 5.8% divided by 12 approximately equals 441.67 yuan, and so on. The total interest for 12 installments is only 3,141 yuan. The annualized return rate obtained through IRR calculation is exactly 5.8%, which is completely consistent with the advertised interest rate. This case clearly shows that ordinary consumers are likely to fall into traps when judging costs only by the advertised interest rate when choosing credit products. And IRR is an effective tool to identify the real interest rate. In long-term investment scenarios such as fund fixed investment, IRR can also accurately reflect the real return level, avoiding being misled by the simple average return rate. According to the Personal Fund Investment Behavior Report, released by the Asset Management Association of China in 2024, the average profit ratio of domestic fund fixed investment investors in the past 5 years was 58%. But nearly 40% of investors made wrong redemption decisions due to misjudging the return rate. Most investors are used to calculating the average annualized return rate by final market value, total investment, divided by total investment divided by years, but ignore the difference in the interest earning time of funds invested in different periods, leading to a serious underestimation of the return rate. Taking a common fixed investment scenario in the market as an example, an investor invests 1,000 yuan in an index fund fixed investment every month for 5 years 60 months. And the final fund market value reaches 75,000 yuan. Calculated by the simple average method, the total investment is 60,000 yuan. The total return is 15,000 yuan. The total return rate is 25%. And the average annualized return rate equals 25%. 5 equals 5%. However, through IRR calculation inputting the monthly investment of 60 months, 1,000 yuan and the final market value, 75,000 yuan, the monthly IRR is about 0.68%, and the annualized IRR approximately equals 8.16%, which is 3.16 percentage points higher than the simple average return rate. The core reason for this difference is that IRR fully considers the investment time of funds. The 1,000 yuan invested in the first month operates in the market for 60 months, obtaining complete compound interest appreciation, while the 1,000 yuan invested in the 60th month has almost no operation time and only participates in the composition of the final market value. The simple average method treats all funds as invested at the same time, completely ignoring the impact of time factors on returns, leading to a significant underestimation of the return rate. On the contrary, if the investor adjusts the fixed investment rhythm, investing 800 yuan per month in the first 2 years and 1,200 yuan per month in the next 3 years, the total investment is still 60,000 yuan, and the final market value is also 75,000 yuan. The annualized return rate obtained through IRR calculation will drop to 7.8% because the funds invested in the early stage are less, and the funds invested in the early stage have a longer interest earning time. The decrease in their proportion directly leads to the reduction of the overall real return rate. This law reminds fixed investment investors that with the same total investment and total return, the earlier they increase the investment intensity, the higher the real return rate. which also provides a quantitative basis for optimizing the fixed investment strategy. The application scenarios of IRR go far beyond personal finance and have penetrated into many areas of life such as career choices and consumption decisions. In career choices, the difference in salary structure will affect the real return through the time distribution of cash flows. An accurate comparison of different offers can be achieved with the help of IRR. Taking common salary schemes in the workplace of first-tier cities in 2024 as an example, Offer A has an annual salary of 180,000 yuan, paid in equal monthly installments, with 15,000 yuan received per month. Offer B has an annual salary of 175,000 yuan, with a monthly basic salary of 12,000 yuan and a year-end bonus of 31,000 yuan paid at the end of the year. From the perspective of nominal annual salary, Offer A is higher than Offer B, but combined with the time distribution of cash flows and the interest-earning capacity of funds, different conclusions can be drawn through IRR calculation. Assuming a risk-free annualized return rate of 3% as the capital appreciation benchmark, inputting the cash flow of Offer B into the calculation, 12,000 yuan inflow per month, an additional 31,000 yuan inflow in the 12th month, and the initial investment is zero, salary is net inflow. The calculated monthly IRR is about 1.43%, and the annualized IRR 17.16%, while the monthly IRR of Offer A is 1.25%, and the annualized IRR 15%. Although the nominal annual salary of Offer B is lower, due to the phased cash flow advantage formed by the concentrated inflow of year-end bonuses, its real annualized return is higher, so it is more worthy of choice. If the year-end bonus of Offer B is adjusted to be paid in the 13th month, that is, only 12,000 yuan inflow in the 12th month and 43,000 yuan 12,000 plus 31,000 inflow in the 13th month, then calculating IRR again, the annualized rate will drop to 16.8%, which is still higher than Offer A, but the advantage has narrowed significantly. This calculation logic provides a new perspective for workplace people to choose salary schemes. When comparing different offers, they should not only focus on the total nominal salary, but also combine the salary payment rhythm to calculate the real return through IRR, especially for positions with a high proportion of year-end bonuses. More attention should be paid to the impact of the time value of money. For families with housing loans, IRR is the core quantitative tool to judge whether to repay the mortgage in advance, which can help families make rational choices between saving interest by repaying the mortgage in advance and appreciating idle funds through financial management. According to 2024 data from the central bank, China's outstanding personal housing loans exceed 50 trillion yuan, with an average interest rate of 4.75%. Among these, the 30-year equal principal and interest repayment method accounts for over 60%. Taking a typical housing loan case as an example, the loan principal is 1 million yuan. The annual interest rate is 4.5%, the loan term is 30 years, and the equal principal and interest repayment method is adopted. Through a housing loan calculator, the monthly repayment amount can be calculated as 5,066 yuan, and the total interest paid is 823,800 yuan. If the family holds 200,000 yuan of idle funds and is hesitant between repaying the mortgage in advance and purchasing low-risk financial products with an annualized return of 4%. The pros and cons of the two schemes can be compared through IRR calculation. First, calculate the IRR of repaying the mortgage in advance. After repaying 200,000 yuan in advance, the loan principal drops to 800,000 yuan. The monthly repayment amount is adjusted to 4,053 yuan. And the total interest paid drops to 659,100 yuan, a reduction of 16,470 yuan. Treating 200,000 yuan as the initial capital outflow and the monthly saved repayment amount, 5,066 to 40,531,013 yuan in the future as the capital inflow. The monthly IRR obtained through IRR calculation is about 0.375%, and the annualized IRR equals 4.5%. Which is completely consistent with the mortgage interest rate. This means that repaying the mortgage in advance is equivalent to obtaining a risk-free annualized return of 4.5%. while the return of purchasing financial products with an annualized return of 4% is lower than 4.5%. So repaying the mortgage in advance is more cost-effective. If a stable investment channel with an annualized return of 5% can be found, whose return is higher than the 4.5% IRR, then it is better to keep the funds for financial management to achieve wealth appreciation through the return difference. This calculation logic is also applicable to scenarios of partial early repayment, such as repaying 100,000 yuan in advance. The annualized return obtained through IRR calculation is still 4.5%, and the decision can be made only by comparing the financial return with 4.5%. In large-scale consumption decisions, IRR can also help consumers identify the real costs of different payment schemes. Taking car consumption as an example, in the domestic car market in 2024, the choice between full payment and loan payment has become a problem faced by most consumers. The real cost difference between different payment schemes can be clearly quantified through IRR. Assuming the total price of a certain car model is 250,000 yuan and two payment schemes are provided, Scheme 1 is full payment of 250,000 yuan. Scheme 2 is a loan of 150,000 yuan with a loan term of 3 years, adopting the interest with principal reduction method, an annual interest rate of 3.2%, a monthly repayment amount of about 4,392 yuan, and a total interest of about 8,112 yuan. If the consumer chooses full payment, the 250,000 yuan fund cannot be used for other investments. So it is necessary to calculate its opportunity cost. Assuming that low-risk financial products with an annualized return of 2.8% can be allocated, the total return in 3 years equals 250,000 times 2.8%, 321,000 yuan. The total interest cost of the loan scheme is 8,112 yuan. After subtracting the loan interest from the financial return, the net return equals 21,028. 11,212,888 yuan. So choosing loan payment is more cost-effective. If the loan scheme adopts the flat interest method for interest calculation, the actual annualized interest rate rises to 6.4%, and the total interest is about 14,400 yuan. At this time, subtracting the interest of 14,400 yuan from the financial return of 21,000 yuan, a net profit of 6,600 yuan can still be obtained, and loan payment is still advantageous. However, if the idle funds of the consumer can only be allocated to financial products with an annualized return of 1.8%, the total return in 3 years equals 250,000 times 1.8%, 313,500 yuan. Subtracting the flat interest method interest of 14,400 yuan, a net loss of 900 yuan will occur, and at this time full payment is more reasonable. This case shows that in large-scale consumer loans, we should not only focus on the total interest amount, but also calculate the real annualized interest rate through IRR, and make decisions by combining the opportunity cost of our own funds, so as to avoid being misled by superficial publicity such as low monthly payment and low total interest. After mastering the IRR calculation method, we can also effectively avoid two common financial misunderstandings in life. These two misunderstandings have caused a lot of wealth losses to consumers, but have been ignored by the market for a long time. The first misunderstanding is the annualized return trap in the publicity of insurance products. Some annuity insurance and increasing whole life insurance products emphasize annualized return of 4.025% and compound interest appreciation in their publicity. But the actual real return obtained through IRR calculation is far lower than the publicity level. According to a typical case announced by the China Banking and Insurance Regulatory Commission in 2024, an increasing whole life insurance product launched by an insurance company marked annualized return of 3.45% on its promotional page. The specific rules are: pay 100,000 yuan in premiums every year for 3 consecutive years, and the cash value of the policy will be 398,000 yuan in the 10th year. Calculated from the superficial data, the total premium is 300,000 yuan, which appreciates to 398,000 yuan in the 10th year, with a total return of 98,000 yuan. The simple annualized return equals 98,000 divided by 300, 0 divided by 10 approximately equals 3.27%, which is close to the advertised 3.45%. However, through IRR calculation inputting the annual premiums, minus 100,000 yuan for 3 years and the cash value in the 10th year 398,000 yuan. The obtained IRR is about 2.98%, which is 0.47 percentage points lower than the advertised return. The core reason for this difference is that the early cash value of insurance products is extremely low. Most of the premiums are used to pay the insurance company's operating costs, commissions and other expenses in the early stage of insurance purchase. The actual funds entering the appreciation account are less, and the real interest earning time of the funds is much shorter than the product term. More alarmingly, such products generally set strict surrender fee clauses. If the consumer surrenders the policy in the 5th year, the cash value of the policy is only 320,000 yuan, and the annualized return rate obtained through IRR calculation is only 2.1%, which is far lower than the 2.92% yield of treasury bonds during the same period, belonging to a typical low-return trap. The second common misunderstanding is the superstition of increasing investment when the market falls in fund fixed investment. Many investors firmly believe in the smile curve effect of fixed investment, thinking that increasing investment when the market falls can average down the cost and ensure profits in the future. However, in fact, if the real return rate IRR of the fixed investment target is lower than the investor's opportunity cost for a long time, increasing investment when the market falls will only expand losses and waste the time value of funds. According to the 2024 data from the Asset Management Association of China, 12% of domestic fixed investment investors have suffered losses of more than 20% due to blind increasing investment when the market falls in the past 5 years. A typical case is a thematic fund that has fallen continuously for 5 years due to the cyclical recession of the industry. The investor invests 1,000 yuan in fixed investment every month. After 5 years, the total investment is 60,000 yuan, and the fund market value is only 48,000 yuan. The annualized return rate obtained through IRR calculation is about minus 2.3%, while the risk-free return rate during the same period is 3%. In this case, continuing to adhere to fixed investment is equivalent to continuously investing funds in negative return projects, which not only cannot obtain appreciation, but also leads to the continuous loss of the time value of funds. The correct fixed investment strategy should be based on IRR evaluation regularly, such as quarterly. Calculate the cumulative IRR of the fixed investment portfolio. If the IRR in the past 1 year and 3 years is higher than the own opportunity cost, and the fundamentals of the fund target such as the quality of the constituent stocks of the tracked index and the investment ability of the fund manager have not deteriorated, you can continue to adhere to fixed investment and even appropriately increase investment when the market falls. If the IRR is continuously lower than the opportunity cost and there are signs of deterioration in fundamentals, you should immediately stop fixed investment and replace it with more high-quality investment targets to avoid expanding losses. Only by applying the core logic such as the time value of money, present value and IRR to specific life scenarios can we truly achieve learning for practical use. In addition to the financial management, credit and consumption scenarios mentioned earlier, these financial tools can also effectively guide decisions in many fields such as children's education fund planning, retirement pension planning, insurance allocation, credit card repayment, and entrepreneurial project evaluation, helping people achieve sound management of wealth in a complex financial environment. In the scenario of children's education fund planning, the time value of money and present value calculation are the core tools. FOR formulating scientific savings plans. According to the China Study Abroad Development Report released by the Ministry of Education in 2024, the average annual cost tuition plus living expenses for Chinese students to study abroad is generally 300,000 to 500,000 yuan. If planning to send children to study abroad at the age of 18, the total cost for 4 years is expected to be 1 to 2 million yuan. Taking the common case of needing 1 million yuan for education funds in 13 years as an example, combined with the 3% risk-free rate Treasury bond yield in 2024. The present value can be calculated as follows. The present value of 1 million yuan in 13 years equals 100 divided by 1 plus 3%, 13,684,000 yuan. This result means that if 684,000 yuan is taken out at one time now and deposited in low-risk products with an annualized return of 3%, 1 million yuan of education funds can be just raised in 13 years. If there is not enough idle funds now, accumulation can be done through regular fixed investment. The monthly required investment amount can be calculated with the help of the PMT function equal principal and interest repayment, fixed investment calculation function. Interest rate 等于 3% 除以12等于 0.25%, period 等于13乘12等于156 months. Present value equals 0, future value equals 1 million yuan. The calculated monthly fixed investment amount is about 4,680 yuan. If the market risk-free rate changes in the future, the fixed investment amount also needs to be adjusted accordingly. If the interest rate rises to 3.5%, the monthly fixed investment amount can be reduced to 4,420 yuan. If the interest rate drops to 2.5%, the monthly fixed investment amount needs to be increased to 4,950 yuan. The advantage of this planning method is that it decomposes long-term goals into executable monthly tasks through quantitative calculation, avoids future capital gaps due to lack of planning, and at the time makes full use of the time value of money to achieve the accumulation of education funds at the lowest cost. Retirement pension planning is another important scenario for the application of the time value of money. With the intensification of population aging, the personal responsibility for pension has become increasingly prominent. Scientific pension planning cannot do without the support of present value, future value, and IRR. According to the 2024 data from the National Bureau of Statistics, the average life expectancy of domestic residents has reached 78.8 years. If retiring at the age of 60 and receiving pensions for 25 years, it is necessary to accumulate sufficient funds after retirement to ensure the quality of life. Assuming a person is 35 years old, plans to retire at 60 and hopes to receive 8,000 yuan of pension per. In insurance allocation decisions, IRR is a core tool for judging the pros and cons of consumption-type insurance and return-type insurance. For a long time, the choice between these two types of insurance has been a confusion for consumers. However, IRR calculations reveal that their actual returns are often lower than risk-free returns. Taking a common critical illness insurance product in the 2024 market as an example, the annual premium for consumption-type critical illness insurance is 5,000 yuan with a 30-year protection period, and no premium will be refunded if no claim is filed during the period. The annual premium for return-type critical illness insurance is 12,000 yuan with a 30-year protection period, and 360,000 yuan in premiums will be refunded upon maturity if no claim is filed. On the surface, return-type insurance seems to preserve capital, but its actual return calculated by IRR, including the annual premium payment of 12,000 yuan, and the refund amount of 360,000 yuan plus 360,000 yuan in the 30th year, the resulting IRR is about 1.8%, which is much lower than the 2.92% yield of 3-year Treasury bonds in 2024. If consumers choose consumption-type insurance and use the annual premium difference, save 12,000 minus 5,000 equals 7,000 yuan, to purchase Treasury bonds with an annualized rate of 2.92%. The total principal and interest after 30 years will be 7,000 times 1 plus 2.92%, 32 divided by 2.92, 387,000 yuan, which is not only higher than the 360,000 yuan refund of return-type insurance, but also provides the same critical illness protection as return-type insurance. This calculation result fully shows that from a financial return perspective, the actual return of return-type insurance is lower than risk-free return, making it a combination of protection plus low-yield financial management, with much lower cost performance than the model of consumption-type insurance plus independent financial management. When allocating insurance, consumers should prioritize the protection function of insurance rather than the financial management function. and avoid the return trap through IRR calculation. The optimization of credit card repayment strategies also cannot do without the guidance of IRR. A reasonable repayment plan can effectively reduce interest costs and avoid the expansion of debt snowballs. According to 2024 data from the central bank, the total amount of credit card overdue loans for more than 6 months in China reached 120 billion yuan, of which nearly 30% of the overdue cases were caused by irrational repayment method choices. Taking a typical credit card debt case as an example, a debt of 50,000 yuan, with the bank offering two repayment plans. Plan 1 is repayment in 12 installments using the flat interest method, with an advertised annualized interest rate of 6%. The monthly repayment amount 等于括号5万加5万乘6%括回除以12约等于 4583.33 yuan. And the actual annualized interest rate calculated by IRR is about 11.07%. Plan 2 is minimum repayment, with 5% of the principal repaid monthly plus a daily interest rate of 0.05%, equivalent to an annualized interest rate of 18.25%. If the consumer holds 20,000 yuan in idle funds, it is necessary to judge whether to repay in advance and the repayment amount. Repaying 20,000 yuan in advance reduces the remaining debt to 30,000 yuan. The monthly repayment amount for 12 installments equals 30,000 plus 30,000 6% divided by 12 2,650 yuan, with the actual annualized interest rate still 11.07%. But the total interest decreases from 3,000 yuan to 1,800 yuan, saving 1,200 yuan. If the 20,000 yuan in idle funds is used to purchase financial products with an annualized rate of 3%, the annual return is only 600 yuan, which is much lower than the 1,200 yuan interest saved, so it should be prioritized for early repayment. If the consumer holds 50,000 yuan in idle funds, repaying the full amount directly can save 3,000 yuan in interest, a return level far exceeding any low-risk financial management, making it the optimal decision. In addition, for debts on multiple credit cards, priority should be given to repaying the debt with the highest IRR actual annualized interest rate, i.e., the high interest rate first principle to minimize interest costs. In entrepreneurial project evaluation, the calculation method combining IRR and risk premium is the core standard for judging project feasibility. For entrepreneurs, judging project prospects based solely on intuition is likely to lead to decision-making errors. Quantifying the project's actual rate of return through IRR and evaluating it in combination with financing costs and risk premiums can significantly improve the scientificity of decisions. Taking a common community coffee shop entrepreneurial project as an example, initial investment of 500,000 yuan including renovation, equipment, initial materials, etc. And predicting cash flows for the next 5 years based on industry data. A loss of 100,000 yuan in the first year due to the market cultivation period. A profit of 80,000 yuan in the second year, 150,000 yuan in the third year, 200,000 yuan in the fourth year and 250,000 yuan in the fifth year. The actual annualized rate of return of the project calculated by IRR is about 8.6%. If the entrepreneur applies for a startup loan from a bank with a financing cost of 6.5%, the average interest rate for small and micro enterprise startup loans in 2024, since 8.6% greater than 6.5%, the project is feasible from a pure return perspective. However, entrepreneurial projects have significant uncertainty, so risk premium must be considered. Usually, the risk premium for retail industry entrepreneurial projects is 2 to 3 percentage points. Therefore, the actual evaluation discount rate equals financing cost 6.5% plus risk premium 2.5% equals 9%. Calculating the project's present value at a 9% discount rate, minus 50 plus 10 divided by 1.09, plus 8 divided by 1.09 squared plus 15 divided by 1.09 cubed plus 20 divided by 1.09 plus 25 divided by 1.09 approximately equals minus 50 to 9.17 plus 6.73 plus 11.58 plus 14.16 plus 15.52 approximately equals minus 11,800 yuan. A negative present value indicates that after considering risk factors, The project is actually in a loss state and not investment feasible. This evaluation logic fully shows that entrepreneurial projects not only need to meet the requirement that IRR is higher than financing costs but also cover risk premiums to truly achieve profitability, which also provides a rational project screening tool for entrepreneurs. From a more macro perspective, the time value of money is not only the core logic of personal financial decisions, but also an important underlying law of macroeconomic operation. The central bank's interest rate adjustments, the optimization of financial regulatory policies, and the pricing mechanism of the capital market are essentially the regulation and application of the time value of money. The two RRR cuts and interest rate cuts implemented by the central bank in 2024 had the core goal of reducing the overall market interest rate level, lowering the opportunity cost of the whole society, increasing the present value of various assets, and thereby stimulating investment and consumption. According to the central bank's monetary policy report, after the two interest rate cuts in 2024, the weighted average interest rate of corporate loans from financial institutions decreased by 0.35 percentage points, driving a 12% increase in corporate investment willingness. Behind this policy effect is the role of the time value of money law. For ordinary consumers, understanding this linkage logic between macro and micro can not only help individuals make more accurate financial decisions, but also predict market changes in advance and avoid wealth risks brought about by policy adjustments. It should be emphasized that mastering knowledge related to the time value of money does not require advanced mathematical foundations. It only requires understanding the core logic and learning to use simple calculation tools. Currently, built-in functions such as IRR, PV, FV, and PMT in Office software like Excel and WPS can meet the calculation needs of most scenarios. Official channels such as the central bank's official website, the National Bureau of Statistics, and the China Banking and Insurance Regulatory Commission provide access to real interest rate data, inflation data, and industry cases, laying a reliable foundation for calculations. At the same time, regulatory authorities have continuously promoted financial literacy popularization in recent years. The Financial Consumer Rights Protection Education Month activity carried out in 2024 included practical knowledge such as the time value of money and IRR calculation as key popularization content. Consumers can systematically learn through official promotional brochures, online courses, and other channels. Returning to the question at the beginning of the article, why can some people achieve steady appreciation of the same amount of funds while others fall into wealth shrinkage? The core answer lies in whether they grasp the underlying financial logic of the time value of money. The time value of money tells us that the value of currency changes dynamically over time. Wasting time is equivalent to wasting wealth. Present value and future value help us compare the value of funds at different nodes fairly across time dimensions. IRR is like a perspective lens that penetrates surface figures to see the true returns and costs. Opportunity cost and risk premium make our decisions more in line with the real market environment, balancing returns and risks. In an era of increasingly complex financial products and changing market environments, we cannot control interest rate fluctuations, inflation changes, or market ups and downs. But we can establish a rational decision-making framework by mastering these basic financial tools. Whether it is buying a house with a loan, financial investment, education planning, or retirement savings, every money-related decision should incorporate considerations of time value. Wealth accumulation never relies on luck, but on rational decisions based on underlying logic time and time again. It is hoped that through the systematic interpretation in this article, readers can truly understand the core essence of the time value of money. Master practical financial calculation tools. Step on fewer pitfalls and achieve more appreciation on the road of wealth management in the future. And use knowledge to protect the safety of their wealth.